Welcome to our deep dive into foreign exchange derivatives. In this video, we'll explore what derivatives are, their types, and their crucial role in today's financial markets. Whether you're a student, professional, or just curious, understanding derivatives is key to grasping modern finance. We'll start with the basics, move through key concepts, and examine real-world applications. By the end, you'll have a solid foundation on how derivatives work, why they matter, and how they impact global market. Let's begin by defining what a derivative is and why it's so important in managing financial risk. Derivative is a financial instrument whose value is derived from an underlying asset. This underlying could be anything from commodities like wheat to financial assets like currencies or stocks. The key point is that the derivative's price depends on the value of something else. For example, a wheat farmer might use a derivative to lock in a future selling price, protecting against price fluctuation. Counting standards such as FAS 133, IAS 39, and AS 30 set specific criteria for what qualifies as a financial derivative, including linkage to the underlying asset's value and settlement conditions. This ensures clarity and consistency in financial reporting. Derivatives come in several forms, each serving different purposes. The main types include forwards, futures, swaps, and options. These products span across 5 major asset classes: interest rate, credit, equity, forex, and commodity. Initially, derivatives were used mainly for hedging commodity price risks, but over time, financial derivatives have become dominant, especially since the 1970s. Today, they are vital tools for managing risk, speculating, and even accessing markets that might otherwise be unavailable to certain participants. Derivatives serve several key economic functions. First and foremost, they help manage risk by allowing market participants to hedge against price movements. They also play a crucial role in price discovery, providing insights into what the market expects future prices to be. Derivatives increase market efficiency by enabling replication of asset payoffs and help organizations access markets or assets that might otherwise be out of reach. Additionally, central banks use derivatives to stabilize currency prices, and the presence of derivatives often leads to higher trading volumes in the underlying markets. Managing risk is at the heart of derivative usage. There are several approaches: speculation, hedging, insurance, and diversification. Speculation involves taking on risk for potential profit or loss. Hedging aims to reduce existing risk and lock in returns. Insurance selectively eliminates negative outcomes, often using options, while diversification spreads risk across different assets to minimize it per unit of return. Each approach has its own strategies and is chosen based on the participant's risk appetite and objectives. Beyond risk management, derivatives contribute to price stability and market development. They facilitate access to otherwise unavailable assets or markets, and central banks often use them to stabilize currency prices. The introduction of derivatives increases participation in the underlying markets, boosting liquidity and trading volumes. However, derivatives also allow for speculation, which, if not managed properly, can lead to significant financial losses. Thus, understanding their functions is crucial for anyone involved in financial markets. While derivatives offer many benefits, they also come with risks. These include counterparty risk, where one party may default; price risk due to adverse market movements; leverage risk, which can magnify gains and losses; liquidity risk, making it hard to exit positions; legal or regulatory risk; and operational risk from fraud or poor execution. It's vital for market participants to assess their risk tolerance and ensure they fully understand the products before trading. Reading the risk disclosure document is a must for all new participants. Derivatives are classified into 5 main asset classes: interest rate, credit, equity, forex, and commodity. Each asset class offers 4 generic products: forwards, futures, swaps, and options. For example, in the forex market, derivatives are used to manage currency risk, while in the commodity market, they help stabilize prices for producers and consumers. This classification helps participants choose the right tool for their specific risk management need. Foreign exchange derivatives, or currency derivatives, are contracts whose value depends on the exchange rate between 2 or more currencies. In India, these contracts derive their value from changes in exchange rates or foreign interest rates, and are settled at a future date. Exchange-traded currency derivatives are standardized contracts traded on recognized stock exchanges, providing transparency and accessibility to a wide range of participants. Forward contract is a private agreement between 2 parties to buy or sell an asset at a predetermined price on a future date. These contracts are customized to the needs of the parties and are typically settled by delivery, though sometimes cash settlement is used. Forwards are over-the-counter OTC contracts, meaning they are not traded on exchanges. They are commonly used by businesses to lock in prices and manage cash flow uncertainty, especially in the context of currency transaction. Let's consider a practical example. Suppose a company expects to receive $5 million in 3 months. The current exchange rate is 1 USD INR 75.1, but the company wants certainty. By entering a forward contract at 1 USD equals INR 75.8, the company locks in its future inflow, ensuring it will receive Rs. 37.9 crores. This protects against rupee appreciation, providing peace of mind and stability in cash flows, even if the market rate changes. Futures contracts are similar to forwards, but are traded on organized exchanges. They are standardized in terms of lot size, underlying asset, and expiry date. Futures are mainly settled in cash, though physical settlement is possible. Margins and daily mark-to-market adjustments are required, and settlement is guaranteed by the clearing corporation. This structure provides transparency, reduces counterparty risk, and makes futures accessible to a broader range of participants. Option contract gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specified price on or before a certain date. The buyer pays a premium for this right, while the seller receives the premium and must fulfill the contract if the buyer exercises the option. Options are powerful tools for hedging and speculation. offering flexibility and limited risk for buyers. Currency options, in particular, allow participants to manage exchange rate risk with precision. Swap is an agreement between two parties to exchange cash flows in the future, based on a prearranged formula. Swaps are often used to manage risks related to interest rates, currency exchange rates, or commodity prices. In a typical interest rate swap, one party pays a fixed rate while the other pays a floating rate. In the forex market, swaps can involve exchanging principal and interest payments in different currencies, helping companies manage both currency and interest rate risks. The forex market, there are two main types of swaps: foreign exchange swaps and currency swaps. Both involve exchanging currencies on specific dates, but currency swaps often include exchanging interest payments as well. For example, a company with a USD loan can use a currency swap to manage both exchange rate and interest rate risks, locking in rates and payments for the duration of the contract. Swaps are typically OTC contracts, tailored to the needs of the parties involved. Let's take a look at a visual summary of the four main types of derivatives: forwards, futures, swaps, and options. Each has unique features, markets, and settlement methods. Forwards and swaps are mainly OTC, while futures and some options are exchange-traded. This visualization helps clarify the distinctions and similarities among these important financial instruments. Here's a comparison of the key features of the four generic types of derivatives. Forwards are customized OTC contracts, futures are standardized and exchange-traded, swaps involve exchanging returns or cash flows, and options provide the right but not the obligation to transact. Each product serves different needs and is suited to different market participants and situations. Over the past 3 decades, the derivatives market has experienced phenomenal growth. Innovations in technology, increased volatility in asset prices, and greater integration of global financial markets have all contributed. Today, a wide variety of derivative contracts are available, offering sophisticated risk management tools and strategies. The market's expansion has led to higher returns, reduced risk, and lower transaction costs for participants. Scale of the derivatives market is immense. As of June 2023, the notional amount outstanding in OTC derivative products exceeded $714 trillion, with foreign exchange contracts alone accounting for over $120 trillion. Exchange-traded derivatives also see significant activity, with daily average turnovers in currency futures and options reaching impressive levels. These figures highlight the central role derivatives play in global finance. There are three main types of participants in the currency derivatives market: hedgers, speculators or traders, and arbitrageurs. Hedgers use derivatives to reduce their exposure to currency risk. Speculators try to profit from predicting currency movements, while arbitrageurs exploit price differences between markets. Each participant plays a vital role in ensuring liquidity, efficiency, and stability in the derivatives market. Hedgers are typically businesses or individuals exposed to currency risk. For example, an importer in India worried about the rupee weakening may use derivatives to lock in exchange rates, protecting against adverse movements. Conversely, an exporter expecting foreign currency inflows may hedge against rupee strengthening. Hedging strategies are essential for managing uncertainty and ensuring stable financial outcomes. Speculators and traders aim to profit from predicting future currency movements. They prefer derivatives over the underlying asset because derivatives offer leverage, lower transaction costs, and faster execution. For instance, a trader expecting the base currency to appreciate will take a long position, while one expecting depreciation will go short. Speculation adds liquidity to the market but also increases risk. Arbitrageurs seek to profit from price differences in different markets. For example, if a currency is cheaper in one market and more expensive in another, an arbitrageur will buy low and sell high, closing the price gap. In currency derivatives, arbitrage opportunities may exist between the underlying and derivatives markets, or between OTC and exchange-traded markets. Arbitrage helps ensure prices remain aligned across markets. India, both residents and non-residents can participate in foreign exchange derivative contracts, subject to regulations by authorities like the Reserve Bank of India (RBI), Securities and Exchange Board of India (SEBI), and others. These regulations ensure market stability, protect participants, and promote fair trading practices. Compliance with guidelines is essential for all market participants. Derivatives can be traded over-the-counter (OTC) or on exchanges. OTC derivatives are privately negotiated and customized but carry counterparty and settlement risks. Exchange-traded derivatives are standardized, transparent, and settled through a clearing corporation, which eliminates counterparty risk. Each market has its advantages and limitations, and the choice depends on the participant's needs and risk tolerance. Exchange-traded markets, the clearing corporation acts as a central counterparty, guaranteeing settlement and reducing risk. This process, known as novation, means the clearing corporation becomes the buyer to every seller and the seller to every buyer. Margining and mark-to-market processes further protect against default. In contrast, OTC markets rely on the creditworthiness of the counterparties, making risk management more challenging. Exchange-traded derivatives offer transparency, lower counterparty risk, and accessibility, but their standardization may not suit all hedging needs. OTC derivatives provide customization but come with higher risks and costs. Increasingly, the lines between OTC and exchange-traded markets are blurring, with innovations like electronic trading platforms and central clearing for OTC contracts. Participants must weigh these factors when choosing their trading venue. India, currency derivatives have been introduced to help both residents and non-residents hedge against currency risk. These instruments are especially important given the volatility in exchange rates and the growth in cross-border trade and investment. Currency futures and options provide price transparency, eliminate counterparty risk, and are accessible to a wide range of participants, supporting economic stability and growth. Currency futures play a significant role in the broader economy. By enabling effective hedging of currency risk, they support international trade and investment, contributing to output growth and consumer welfare. Empirical evidence shows that exchange rate volatility can negatively impact trade, so currency futures help stabilize returns and promote economic activity. They also attract a diverse range of participants, from hedgers to speculators and arbitrageurs. Sum up, foreign exchange derivatives are powerful financial tools that help manage risk, facilitate price discovery, and enhance market efficiency. Understanding the types, functions, and risks of derivatives is essential for anyone involved in finance. As the market continues to evolve, staying informed and making prudent choices will be key to leveraging the benefits of derivatives while managing their risks. Thanks for joining us on this journey through the world of Forex derivative.